first thing that I did see, bro, when I was marking up um SPX, I noticed that number one, bro, we had dynamic liquidity being built right here. So meaning that we had liquidity basically at this area, and we were basically bouncing off this area, so this 4 hour time frame. So I'm gonna like literally mark this up just so you can have a better idea. So boom, we had liquidity right here. We also had liquidity right here, also right over here. So I'm gonna mark this up right there, and then put this here. So boom. So yeah, we had liquidity here. We had at the time, bro, we had London lows here, and we had my supply and demand zone here. Now this is basically all-time high, which was here. Now the reason why, bro, like for me, I wouldn't recommend you ever longing when we're all-time highs, because there's no data here, bro. There's nothing that I can kind of gauge, a potential exit from. So like even if we were to break, I personally, I'm gonna be really honest with you, I wouldn't have never taken a trade, just because there is no data for me to kind of base it off where we could potentially go. Now, I also did notice that we did have a 4 hour imbalance right here. So I'm gonna mark this up for you right here so you can have a better idea. So there was a 4 hour imbalance right here, and 50% of that imbalance was here. Hence why, I marked up right here where it says 4 hour imbalance. I always mark up 50% of it. And then on the 2 hour time frame, the exact same thing right here, bro. We had an imbalance right here, which is basically 50%. And then we had liquidity here. So, I mean, obviously, bro, whenever you're looking at price and you want to like identify where is liquidity, look at where there's equal highs and equal lows. Where are we basically ranging from consistently? And it's basically all up in this area. So that's why I kind of had my liquidity here. And there's two types of liquidity that I look at. There's something called dynamic liquidity, where we go up like this, and basically there is still liquidity where we basically are like this, meaning like we're straight, just like so, like that, right? So I noticed that here we had still liquidity, meaning that we were bouncing off this area a lot. So this is an area that we were gathering a lot of liquidity. London lows here. We had an additional liquidity zone up here as well as up here, right where my supply and demand zone is. Now, as soon as basically the 1 hour time frame opens, so I always look at the 1 hour, bro, because it gives me more of a market structure. So now I can kind of see, okay, we have the dynamic liquidity being built here. We have the still liquidity being built here. What's my benchmark? So obviously I know that all-time highs is here. I know that my supply zone is here, and I know that my demand zone is here. So I have my key area where I've almost box price in with my supply and my demand. I have my dynamic liquidity here. So I know that, even though we were going up, market lost its structure. Why? Because look, bro, we created higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. So we were kind of ranging off this level, and we struggled off this area, and then we started creating lows, lower lows, lower lows, lower highs, and you started seeing that pattern. We were just ranging off this level here, creating equal highs, equal lows, equal highs, equal lows, equal highs, equal lows, and then we rejected, and then boom, we came back up here, tested my London lows area, and then we came back up here, testing this area that was my supply zone, where we had resting liquidity. So basically, bro, because of that, let me delete this. Because of that, I, on the 5 minute time frame, said to myself, you know what? Like, we're basically ranging, and we broke my demand zone. And for me, bro, we ran way too fast for me to get into a trade. Like, realistically, it was way too quick for me to get into a trade. And I said to myself, you know what? If we break my supply zone and we go to all-time highs, I'm cooling it, and I'm not going to be mad if we do. Now, what I noticed on the 3 minute time frame is that we rejected these higher highs right at my area of my supply zone. Now, you always want to remember this, bro. Your higher time frame needs to align with your lower time frame. So think of it like this, bro. Let's say that you're an aspiring boxer. This is probably the best example. And you're 110 pounds, and you're trying to fight a 300-pound boxer. Like, there's a huge weight imbalance and a weight difference that he is gonna always win because he's just massively more bigger than you. So you always want to rely on your higher time frame. So what does a higher time frame say, bro? It says that we've struggled to break these highs multiple times, bro. Like we struggled, here, we struggled here. I believe if it was, yeah, that was the peak. So we struggled a lot here. So we were just bouncing, bouncing, bouncing. We had a sharp move down, and then we built the liquidity here, came back up, equal highs, equal lows, and then on the 5 minute time frame, we basically shot up. And if you notice this, bro, again, I don't mean to go back and forth from higher time frame to lower time frame, but if you notice, where and you want to ask yourself this, bro, when you look at a chart, where is the liquidity at? Where is the money at? Where can I potentially have my targets? And not to say that I caught this whole move down, but I pretty much closed my position like right at this liquidity zone. So like literally right here. So I caught about a 42-point catch on Friday, which is one of my biggest trades ever. But it was because I knew that there was liquidity down here that needed to get swept. So London highs was here. Hold on. I'm actually going to mark up London highs with you actually right now. So London high was right here at 8 in the morning. Basically my demand zone. This is perfect timing. So London high was my demand zone. So as soon as we broke that, bro, we took the liquidity off there, and price was moving way too fast for me. So at that point, I'm like, you know what? Like I already missed the move. I'd rather be late and wrong than early and right. So obviously, like we ran up. One candle was like freaking like 11 points. And then right when we got to my higher high level, my supply zone, I started seeing price lose strength on the hourly time frame. So I started seeing price shoot up and aggressively pull down. At this moment, bro, this is where I executed my sell position, literally right here. And basically, as soon as we rejected here on the 3 minute time frame, you can see here that we had a big move here at 45. We rejected. Next candle print, we had a sharp move down. I got in like basically right there at my supply zone. And then boom, within one candle, we were already up about 11 points. So there's already a 2-hour multiple on my trade. And then I held, this is where I closed one of my positions. And then I held my other one. And then I wanted to see us break and take these lows. My stops were like up here. So even if we were to reverse, I would still gain like 4 points. So I wasn't sweating. Worst case, I'd make, 15 points for the day. And then basically, bro, by like 11 a.m., we had this sharp ass move down. And this is where my trade hit take profit right over here, which was basically 20 something points. So like the reason why I kind of had that was because we rejected the highs. We created a rejection candle. I believe, like, if I'm not mistaken, like I'm not too familiarized with the name, but this is almost like a bullish shooting star rejection candle from the top. Like we literally had something like this. Like we had the uptrend here. Let me go on the higher time so you kind of see what I'm looking at. See, we had and obviously it doesn't look as perfect, but we had the uptrend from these higher lows all the way up. And then we created that rejection shooting star candle at the very high to a reversal to that bullish trend. And then boom, we dropped down. So that's why for me, bro, I took specifically sells on gold, not gold, the S&P 500, because overall this kind of happened. I didn't expect it, bro. Real shit. I didn't expect it to drop this, but I knew that we had liquidity here on the 4-hour. We had the imbalance right here. I know that in the 2-hour, we had the imbalance here. So now when I mark up my position, we basically have imbalances here that possibly need to get filled. But I'm not going to fix my chart until basically tomorrow, until Monday night, because the market is open on Tuesday. Just giving you a heads up, bro. There's no trading on Monday because it is a U.S. holiday. I forget what day it is. It is Columbus Day, which is Thanksgiving for us. And then Jerome Powell speaks. So just be very careful this week, bro. A little tip, bro, when it comes to just trading overall. My recommendation, bro, stick to S&P 500. It moves smooth. It moves nice. It's not so fast. NAS 100 and all these other peers move very, very quickly. Like if I look at NAS, like I was actually marking NAS up with one of the guys in the chat recently. Let me go to indices. NAS, where you at? Right here. And I was marking it up with him, bro. And I mean, it was very choppy, bro. Like if you really think about it, like, look, Like let's go. Let's mark this up together, me and you. So boom, 4 hour. We have all-time highs right here. So boom, here, all-time high liquidity, and that's there. And then now from there, I want to identify London high. London high. Let me go on the hourly. So this is where I can. The hourly works a little bit more smoother for me. London high before 9 a.m. So we'll go 8 in the morning. So we'll go here. This is London high. Boom. So let me change this. London high. Bet. Now we're gonna identify London low. Let's go London low. Right here. Perfect. Come here. Bam. London low. London low. So now we have this marked up beautifully. So now we want to identify, bro, our key area. So like obviously disregard this big ass drop that happened here, but we're gonna be looking at the chart around 8 to like basically 8 in the morning to 8:45. So obviously, very simply kind of putting it, this right here is a key area for our actually I don't even need to mark this up because it's already there. So this will be like our supply and our demand zone as well, because it aligns very perfectly with our London high as well as our London low. Now that we have that marked up, let's identify our potential liquidity zone. So liquidity zone, if we were to go for sells, let me go on the 4 hour so it could be a lot more cleaner. So liquidity zones could be here. The reason for it is because you can see that we tap at these highs here, 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 and here, and we have a change of character as well as nearing a break of market structure there. So come here, place our liquidity out there. So now we have a potential target. So if we were to go for sells, let's just say, for example, and I know it's pretty straightforward, we did drop. If we were to go to sells, this would be a potential target for NAS, this liquidity zone right here. So now that we have that marked up, let me look for dynamic liquidity being built. So this is our still liquidity. So now we're going to go dynamic liquidity. So let me go on the daily for this. So this is very obvious, as you can see here. And look how perfect everything aligns more on the bigger time frame. So we're going to come here. Boom. Here. Dynamic liquidity. So again, there's always two types of liquidities, bro. There's your still liquidity, your dynamic liquidity. So now that we have that marked up, bro, now we want to go on the lower time frame. So now we have that marked up, we can identify where we want to get into our positions. So let me go on the daily one more time, actually, see if I can find another pool of liquidity. Still liquidity would be, I would say, like right here. Perfect. There we go. So we have another pool of liquidity right here on the daily. We actually broke that like right here. Another area would be here actually. Actually, this would be a better area right here. Because look, we touch. Liquidity is being built. Dynamic liquidity starts technically from down here. There's liquidity here, there's liquidity there. So now we go on the 5-minute time frame. So now let's analyze this trade, bro. So again, bro, me personally, bro, this is just me. Don't take what I do like for anything, but it doesn't make any sense for you to long, at an all-time high, because again, there's something called, I'm gonna actually write this down here, known versus unknown. So obviously, bro, like right now, when something is at an all-time high, it's a very risky trade, because you have essentially zero data to go behind a target. So like I can't, like, it's like me, bro, for example, it's like me. I mean, you can relate to this because you can dunk a basketball. I can. It's like how to dunk a basketball because you've done it many times. I don't, because I've never done it before, because that's an unknown area for me, but it's a known area for yourself. So that's what we want to always remember, bro. So you want to look at the charts. You always want to remember, okay, where is my known area? Where is my unknown area? So now that I have that essentially all marked up and kind of smoothed out, now I want to identify where I could possibly take my trade. So obviously look down here, bro, so you can see the kind of the time. So obviously this is the hourly time frame. Let me go on the 5 minute. Beautiful. So you can see here, bro, during New York Open, around 9:10, 9:15. So right here, bro, this is where I kind of figured where you would have got clipped, because I'm kind of guessing that you saw this price action here and you're like, yo, we're gonna go up, and it's understandable, but you need to think like an institution, bro. Why, if we do break, where are we going to target? Like where? Like what data? So like there's no liquidity up here. There's liquidity down here. So again, a retail trader would probably get in maybe off these breaks of these highs. And, you know, again, I don't know what you're targeting, but like, you know, let's say you're targeting these highs or whatever. I don't know if that's something that you want to do. Target 50 points. And then your SL could be like maybe down here, and you're looking at it maybe like a 1 to 2. But even at this point, this isn't a high probability setup because you're in the middle of a lot of wicks. So obviously this is probably where you got clipped, bro. I kind of see that, but that's why like when you're trading, bro, I don't know if you have the ability to have two devices, but for me, I have my 5 minute chart on my monitor and then I have my 1 hour chart on my iPad. So I'm able to see how price action kind of gauges in terms of the higher time, because you want to remember this, bro. The 1 hour time, like someone asked me this recently, like why do I use the 1 hour time frame a lot? And it's because the 1 hour time frame is where clarity meets precision. So basically, like the 4 hour, the daily, the weekly, the monthly, like it's so big, bro, that like you can't really see what's going on. But with the hourly time frame, there is some structure, so you can clearly see, bro, that we rejected off here and off here. So almost creating like an M formation, or like a W, my bad, or a W, a double top, a W, my bad. And at that point, you could have been like, okay, you know what? There's no point of a short. There's no point of me getting in. Now, another thing you want to remember is this: we created here a ranging market, but whenever you see a ranging consolidated market, you want to ask yourself, where are we ranging to? Because yes, a ranging market, bro, could be going like this, but in reality, it never looks like that, bro. A ranging market either looks like this, like either it's ranging, but it's going up, or like this, and it's going down, but it's ranging. So a ranging market always moves somewhere. So obviously here, bro, we're creating equal highs, equal lows, equal highs, equal lows, equal highs, equal lows, equal highs, equal lows, until eventually we break that basically trend. And we take one last move up, take the liquidity up here off the dynamic liquidity being built, and then boom, we drop down. So right now let me run you through my process of this trade. So obviously, bro, this is a position where I wouldn't want to enter, just because like I am already like this is an engulfing candle. So what do? We go on the we're on the 5 minute time frame. We wait for a retest, bro, to give us a clarity and confirmation the move is going to happen. So on the retest, bro, I would have gotten in right here, right as soon as we touched the fair value gap, and I would have placed my stop loss right above this whatchamacallit, this London high. So again, I don't know what stop loss you use, bro, precisely. I don't know, and I don't know. I mean, I don't trade NAS 100, so I can't say, but I know for SPX, for example, a good risk to reward will be like 15 to 10 points to risk 3 to 5 points. That's a 1 to 2. So for this situation, you're risking about 60 points, and you're going to be able to catch 230 points because we're targeting the liquidity. So when we go on the bigger time from the 1 hour, you can see, bro, my stops are tucked above this liquidity zone, and I'm targeting basically this pool of liquidity right here. So that's where I would have gotten in, bro, right at this retest, risked 60 points to basically make 230. This would have given me about a 3.9 R multiple trade. Now, if I want to be really like conservative and really not conservative, like really tight in terms of my risk, then I can lower my risk down to maybe this level right here, right at this break of market structure right here. Actually, this probably would have been a better risk to reward in my opinion, not up here. Like this would have been okay, but this would have been better up here. So now you shave your risk like almost half. So now you're risking 30 points to basically make 230. You have a 7R multiple trade. And even if you don't catch the whole move, like obviously this is a one candle move. Let's go on the 5 minute time frame. Like this is a nice move because you could have basically caught it to even this level. Like if you would have caught 100 points, that's a 1 to 3, bro. That's still extremely good. And right at this retest, you could have basically taken your position up. But that's how I would have traded NAS 100, bro. So you always want to remember that. Watch this video. It's kind of like, if you want to make it make sense. But the first thing that I do is I always mark up all-time high. Second thing I do, I mark up my real high and my real low, which is my London high and my London low. Number three, I look at overall liquidity in the market. So I identify, okay, where is there liquidity? Number four, I look at basically where's overall trend on the higher time frame. And then the last thing I look at, bro, is basically geopolitical events like Forex Factory, CNBC, et cetera, et cetera. But yeah, bro, that's the kind of breakdown the trade that I took and kind of so you can have a better understanding of how to mark up. And the last thing I'll tell you, bro, is just manage that risk, bro. 200 loss is massive, bro. Like every single position that you take, obviously, relatively speaking to whatever your account size is, you should be risking like, for example, like let's say your account is like 100, like not $100. Let's say your account is $500. So that means that every position that you take, you should be risking like max 25 to 30 bucks to make 60 to $70. That's a 1 to 2. And if you do that within a weekly span, bro, and you catch 65 to $80 wins, by the time the week is done, you'll have a $300 profit. And that's how you compound your account over time by being like precise and trusting your A plus setup, bro. But that's a breakdown, bro. Let me know if you have any other questions. I'll be more than happy to do a quick breakdown for you.